Hi guys, today we'll study Ventas, a healthcare REIT founded in 1998 and based in Chicago. VTR focuses on senior living facilities and has a large market cap of about $25 billion. Let's start with its business model. Ventas operates three business segments. First, senior housing operating portfolio operates senior living communities and contributes about 66% of total revenue. This segment is not just a typical real estate rent business. VTR partners with third-party operators to manage daily operations while retaining the property ownership and sharing its financial performance. So this segment has more ups and downs than usual rent business. The second segment is similar to the traditional office rental business. But the difference is VTR focuses on healthcare providers, research institutions, and biotech companies. This segment contributes about 19% of revenue. Lastly, as the name indicates, the triple net lease segment generates revenue through long-term triple net lease agreements. But in this case, the properties are skilled nursing facilities, hospitals, and senior housing communities. So this segment is similar to the shop segment, except that VTR is one step away as a more pure-play real estate rental business, rather than sharing the ups and downs of the underlying facilities. This segment contributes about 14% of total revenue. Now, let's check VTR's historical performance in terms of stock price, profits, and dividends. VTR had more sudden and negative impact from the COVID because of its nearly 80% revenue exposure to the senior housing facilities. Although VTR stock price recently recovered, it still lags behind the US REITs index. Moving on, if we just look at its revenue, Ventas has achieved a steady increase with a 10-year CAGR of 5.6%. However, its profitability has declined noticeably since 2017. The FFO margin dropped from 42% to just 26% in 2024. So we dug deeper into this long-term margin decrease, starting with the segment margins. As we can see here, the triple net lease segment has the highest margin. This is not surprising because here, VTR just collects the rent. On the other hand, the shop segment has the lowest margin because here, VTR has to pay for all the operating expenses, including the third-party manager fees. And the management steadily is shifting the triple net lease properties into the shop business model. So if we combine these two information, we can understand that the decline in profit margin is primarily driven by the business mix shift. Prior to COVID, VTR's dividend was about $3 per share range. However, in 2020, Ventas had to cut its dividends primarily as a consequence of severe impact from COVID-19, which decreased occupancy rates while significantly increasing operating expenses. And the dividend per share has not recovered since the cut in 2020. As a result, the dividend yield is hovering around mid 3% range in the last 4 years. For the past 5 years, VTR has returned about 33% to shareholders, including the dividend and stock price changes. This is only 5.8% per year, so it's not really stellar result. If so, why is this a time to look at VTR? And we can answer that through the market trend, especially the US population shift. This relates to the reason why the management team is shifting its triple net lease into shop business model, even though it has lower margins at the moment. Let's start with the demand analysis. US population of seniors who are over 80 years old, whom VTR primarily serve, is expected to grow 27% over the next 5 years, compared to historical 5-year average of about 4% per year. This is mainly because the baby boomer generation is starting to join this senior pool. The next graph shows this trend in a different angle. The share of elders who are 65 years old and above are currently about 17% of US population, but this is expected to jump above 20% in just 6 years and continue to climb. If we add in the fact that the baby boomer generation has over 50% of wealth in the US and the economics of senior housing for retired seniors, the demand for senior housing will grow solid over the next decade. If we take a step back, supply was lower in the early 2010s as an aftermath of the 2008 global financial crisis. But as demand starts to pick up and the lower interest rate environment in the 2010s continued, supply of senior housing surpassed the increasing demand from 2015 to 20. As we see here, the oversupply lowered shop margin in 2019, and the COVID impact in 2020 had very large negative shock. On top of this, the rising inflation and interest rates in recent years resulted in the lowest construction since 2009. And as a result, the construction of senior housing as a percentage of inventory is at a record low of just 1%. Also, the negative impact of COVID put pressure on senior housing owners who had high debt service costs and low net operating incomes. And VTR management believes that this is a great time to take control of these distressed assets during the downturn. So in conclusion, demand for senior housing is outpacing supply, with move-in rates at significantly higher levels than the pre-pandemic level. And to take advantage of this supply constraint, VTR management is actively increasing its shop footprint as we saw before. With this industry background, let's take a look at VTR's key operating metrics. As we can see here, the overall occupancy rate has been lagging, especially at the shop segment. Before COVID, it was stable at around 87%, but fell to 79% in 2021. And since then, it's been recovering, and most recently, it's at an 84% level. Looking at the tenants of VTR, the senior housing business model itself tends to have low tenant risk, because each individual do not have a large negotiating power. So here, occupancy rate could be more important to track. However, SHOP still faces other tenant-related risks. For example, Atria, which is one of the third-party operators, manages 16% of properties. And in the triple net lease portfolio, tenant risk is more noticeable. For instance, the top 3 tenants contribute more than 20% of total NOI. Such high concentration caused trouble when Brookdale, the largest tenant, announced that it would not extend its leases on 121 properties. These leases were to expire at the end of 2025. Although this particular risk was mitigated when Brookdale later decided to renew 62 units for 10 years, the overall tenant-related risk still remains. VTR has operations in 3 countries, the US, Canada, and UK, but the US comprises over 90%. And within the US, California and Texas have the highest number of properties, each exceeding 100 units. But in general, it is well spread out through the country. Compared to the healthcare sector, VTR's payout ratio has consistently been lower. Especially the most recent payout ratio is just 58%. So in this perspective, the dividend safety seems high. Here is the overall summary of operating metrics. And now we can move on to the financial risks. VTR's debt has steadily increased over the years as the company expanded its asset base. But it's worrisome to see that VTR's debt to EBITDA ratio of 7.5, which is higher than the REITs overall of 6.2 times. This is mainly because the management continues to invest into senior housing despite its short-term challenges. On the other hand, VTR's adjusted leverage ratio is just about 6.3 times, and it's on a decreasing trend. And it's good to see that the credit rating agencies seem to agree with this trend. So VTR has BBB+ or Baa1 ratings, a level that is comparable or a bit higher than its healthcare peers. VTR's effective interest rate is going up recently as general market rate has gone up, but it's defending pretty well at just 4.4% level. The debt repayment schedule is evenly distributed throughout the years, which does not appear to place a heavy burden on Ventas. So here is the summary of the financial risks, and we will summarize the pros and cons of Ventas. First positive aspect is the supply-demand dynamic, which, if plays out, will significantly boost VTR's performance in the next few years. And the second bullish point is management team is eager and well positioned to take advantage of this trend. However, if this thesis does not play out, the fact that Ventas is not just a real estate owner, but has more exposure to the ups and downs of shop business will be a negative factor for the shareholders. Second bearish point is its high debt burden. And third, the REIT currently has a low dividend yield of just around 3.1%. So overall, VTR's performance is heavily tied to the supply-demand dynamic that will play out over the next few years, which poses high uncertainty. However, recent announcement that Brookdale's contract renewal resulted in 38% increase in cash rent is a good news for investors. Now let's finish up with the valuation. We will take a look at the valuation in 3 perspectives. First is dividend yield. Current 3.1% is much lower than what we can get from just investing treasuries, which is above 4%. And if you want to get this 4% range while waiting for the upside for the senior housing to play out, we need to purchase these REITs at around $43 per share. Next, if we look at the historical trading multiple trends, VTR's current trading multiple is at about average level. So nothing to get excited about, and in order to buy VTR at a favorable multiple, the stock needs to fall about 20% below $47 per share. Lastly, If you really believe the supply and demand is in fact favorable to VTR, and that the increasing demand will increase the shop occupancy, which will result in a higher margin for the company, we need to do a quick bottom-up calculations, and we assumed three key factors. First is about 6% revenue growth for the next 5 years, which is in line with the historical trend. Second, we assumed normalized profit margin before the COVID crisis. And third, we applied historically reasonable multiple, and this resulted in about 9% IRR for a long-term investment in these REITs. This is obviously not such a satisfactory number. Normally, I would aim for 15% of IRR or above, and in order to achieve that, the share price needs to go down to about $45 per share. But in the meantime, I don't need to just look at VTR. I will be studying and look for opportunities in other healthcare REITs such as DOC, WELL, MPW, and beyond. So in order to get updates on these other healthcare REITs, please hit the like button below and subscribe to the channel. Thanks for watching, and I'll see you guys in the next REITs analysis.